Ever wondered why two traders with the same strategy can have drastically different outcomes? Could psychology be the missing piece in your trading puzzle? Let's dive into the world of trading psychology, a realm often overlooked yet critical in shaping the outcomes of our trading endeavors. Enter The Disciplined Trader, a classic work by Mark Douglas that serves as a beacon, guiding traders through the psychological complexities of financial markets. Douglas, armed with a wealth of experience and insights, invites us to explore this fascinating field. His book is not just about trading. It's a journey into the depths of our minds, challenging us to reevaluate our perceptions, attitudes, and beliefs about the markets and our role within them. So buckle up as we delve into the first chapter of The Disciplined Trader, a chapter that sets the foundation for the transformative journey ahead. Mark Douglas, in his seminal work, attempts to answer these questions and more. Mark Douglas didn't write this book on a whim. He saw a problem and aimed to solve it. With a keen understanding of the complexities of the financial markets, Douglas witnessed firsthand the struggles faced by traders. He perceived an unspoken challenge, a common thread that seemed to weave through the experiences of many. This was no ordinary obstacle related to figures, charts, or market trends, but something far more profound and often overlooked: the psychological aspects of trading. Douglas's career in the financial sector provided him with a unique vantage point. He observed traders grappling with the pressures of the market, their decisions often swayed by fear, greed, and other emotions. The realization dawned on him that while traders were well-versed in market analysis and strategies, they were ill-equipped to handle the psychological demands of trading. This understanding sparked a drive within him, a mission to equip traders with the mental tools necessary for success. The author's motivation to pen The Disciplined Trader was thus born out of this genuine desire to address the psychological challenges faced by traders. He recognized a void in the trading landscape, a space where the mind's role was undervalued and its influence underestimated. He set out to fill this void, to shine a light on the often shadowy corners of trading psychology. Douglas knew that the journey wouldn't be easy. He was challenging the status quo, proposing a shift from traditional trading methodologies that focused primarily on technical analysis and market strategies. The path he was paving was not just about introducing a new perspective, but about stirring a paradigm shift in the world of trading. The author's goal was clear: to help traders understand and navigate the psychological terrain of the financial markets. This ambition propelled him to delve deep into the human psyche, to explore the emotional undercurrents that drive trading decisions, and to present strategies for maintaining mental equilibrium amidst market volatility. Douglas's desire to help traders overcome these psychological hurdles formed the bedrock of The Disciplined Trader. His work stands as a testament to his commitment to empowering traders, not just with market knowledge, but with the psychological resilience needed to thrive in the unpredictable world of trading. His motivation was simple, yet profound: to transform the way traders perceive and interact with the financial markets. Douglas was convinced that there was something missing in traditional trading approaches. He saw a glaring void, a gap that needed to be filled to truly empower traders. His conviction was rooted in the belief that trading was not just about numbers, market trends, or sophisticated algorithms. It was, above all, about the human mind, the trader's psyche, the emotions, and the thoughts that guide every decision in the trading process. Douglas argued that the field of trading was in dire need of a fresh thinking methodology, one that would put the psychology of trading front and center. He believed that the conventional focus on technical analysis, fundamental indicators, and market strategies was not enough. While these elements are undoubtedly vital, they only tell half the story. The other half lies in the mind of the trader, in the fears, hopes, expectations, and biases that inevitably color every decision. Douglas was adamant that understanding the psychology of trading was as important as understanding the markets themselves. He asserted that the two were intertwined, each influencing the other in intricate and often unpredictable ways. He urged traders to delve into their own minds, to understand their emotional responses to market fluctuations, to recognize their cognitive biases, and to develop strategies to keep them in check. This new thinking methodology, Douglas argued, would enable traders to make more rational, less emotionally charged decisions. It would help them to maintain their composure in the face of market volatility, to stay disciplined in their strategies, and to avoid the common pitfalls that often ensnare traders. Douglas saw this shift in thinking as a vital prerequisite to trading success. He believed that only by integrating this psychological dimension into their trading strategies could traders truly unlock their potential and achieve consistent, long-term success. Douglas firmly believed that a shift in thinking was pivotal to trading success. He envisioned a new era of trading, one in which traders would not only master the markets but also master their own minds. This, he believed, was the key to transforming the art of trading from a game of chance into a discipline of the mind. Douglas was not one to shy away from challenging the status quo. In the world of trading, conventional methods have long held sway, with the majority of focus placed on market analysis and trading techniques. Technical charts, fundamental indicators, market forecasts, these were the tools that traders were taught to wield. And while Douglas recognized these elements as important, he saw them as only part of the equation. He observed that these traditional approaches, while providing a solid foundation, often fell short when it came to dealing with the unpredictable and dynamic nature of the financial markets. The markets didn't always behave as the charts and indicators suggested they would. Unforeseen events could turn predictions on their heads. And in these moments of uncertainty, it was the trader's mindset that determined their course of action. Douglas argued that conventional methods were limited because they overlooked this crucial aspect. They focused on the external, the market trends, the economic indicators, the trading techniques, while neglecting the internal, the trader's thoughts, emotions, and psychological responses to the market's twists and turns. This neglect, Douglas contended, could lead to repeated mistakes, emotional turbulence, and inconsistent performance. He saw traders who had mastered every technical analysis tool in the book, yet still found themselves caught in a cycle of fear and greed, of overconfidence and doubt. They had the right tools, but they didn't have the right mindset. And it was this realization that led Douglas to advocate for a more holistic approach to trading. In his view, integrating psychological discipline into trading was not just a nice-to-have, it was a necessity. Traders needed to understand their own mental processes, to recognize their emotional triggers, to develop a disciplined mindset that could weather the market's ups and downs. Only by doing so could they break free from the cycle of emotional trading and achieve consistent performance. For Douglas, a holistic approach that included the trader's mindset was the key to unlocking consistent performance. Every trader seeks consistency, but how does one achieve it? Mark Douglas, in his seminal work, The Disciplined Trader, provides an intriguing perspective on this quest. The pursuit of consistency, according to Douglas, isn't about achieving a flawless winning streak. Instead, it's about developing a steady approach to trading, one that can weather the storms of fluctuating markets. Douglas argues that consistency in trading is not a product of mastering complex strategies or possessing an encyclopedic knowledge of the markets. Rather, it's about understanding the psychological factors that influence decision-making. He proposes that the key to consistency lies in recognizing and managing our emotional responses to the ups and downs of trading. Fear, greed, hope, and regret, these are the emotions that can cloud our judgment, leading us to make impulsive decisions or cling to losing trades. But how can we manage these emotions? Douglas suggests that the first step is to acknowledge them. We have to accept that these emotions are part of the trading process, and they can't be completely eliminated. The next step is to develop strategies for managing these emotions. This could mean setting strict rules for when to enter and exit trades, or it could involve practicing mindfulness to stay present and focused. Douglas also emphasizes the importance of discipline in achieving consistency. Discipline, in this context, means sticking to your trading plan, even when the markets are volatile and your emotions are running high. It's about making decisions based on logic and evidence, rather than reacting to the emotional roller coaster of trading. Finally, Douglas advocates for resilience and a steadfast mindset. The markets are unpredictable, and trading can be a tough game. There will be losses, and there will be setbacks. But it's how we respond to these challenges that defines our consistency and ultimately our success as traders. In Douglas's view, consistency in trading was a product of discipline, resilience, and a steadfast mindset. These are the pillars upon which a successful trading career is built. And as Douglas reminds us, it's not just about the strategies we use, but the mindset we bring to the table. So, what can we take away from Douglas's introductory chapter? Mark Douglas, in his seminal work, The Disciplined Trader, emphasizes the importance of mental discipline in trading. He identifies a common struggle among traders, grappling with the psychological aspects of trading. He also highlights the necessity for a fresh thinking methodology, one that places equal importance on the psychological factors influencing decision-making in trading, as it does on technical analysis and market strategies. Douglas points out the limitations of conventional methods that focus solely on market analysis and trading techniques, arguing that neglecting the psychological component can lead to repeated mistakes and inconsistent performance. He advocates for a more holistic approach to trading, one that aims for consistency and integrates mental discipline into the trader's toolkit. As we delve deeper into The Disciplined Trader, we will uncover more about this transformative approach to trading psychology. Until then, remember, the mind is the ultimate frontier in the world of trading.
Thank you for watching. Share this with friends and family, and please subscribe.